90% of traders blow up their futures account in under 90 days. In this video, I'm gonna show you exactly how to avoid that. This is a complete step-by-step guide to futures trading for beginners. From getting started, to building a profitable strategy, to managing risk the right way. And if you stick with me until the end, you'll walk away knowing more than 99% of people watching futures videos on YouTube right now. Plus, I will even review 3 bonus tips that every beginner needs to hear. The kind of tips that can literally save you years of wasted time and thousands of dollars in losses. Now, don't worry, I'm not some 18-year-old TikTok guru with like a rented Lamborghini. I actually trade for a living. My name is Brett Goh and I've been trading for nearly 7 years. And this year alone, I've already crossed over $1 million in profits. Every single trade documented on my second channel, Live Brett Trades. I've also helped hundreds of students become 6-figure funded traders. In fact, we are the only mentorship program with an endless scroll of real student results. Just look at this. Countless of students getting funded, scaling to 6 figures. I can go on and on, but I'm pretty sure that you're here to learn about futures, right? But you can just stop at any point of time for proof that I'm actually legit. Alright, now that you know who I am and what I'm about to teach you actually works, let's get straight into it. First of all, why trade futures? Why not just trade crypto, stocks, option, forex? Well, here's the reality. Futures, they offer some of the best opportunities for active traders. Firstly, you get high leverage with regulated brokers, which means unlike shady offshore brokers in forex or crypto which will run away from your money, futures are traded on centralized exchanges like the CME. That means tighter spreads, transparency pricing, and real regulation protecting your capital, your hard-earned money. Second, futures markets are open almost 24 hours a day, from Sunday evening to Friday evening. You can trade around the clock with just like a short daily 1-hour reset. This makes them incredibly flexible for traders all over the world, no matter your time zone, no matter what you are working at, no matter your lifestyle or your any obligations. You can cater at least 1 to 2 hours per day to trade futures. Thirdly, you get deep liquidity on the major contracts like the S&P 500, the Nasdaq, the crude oil and gold, etc. This means that when you want to enter or exit a trade, you can do it instantly without slippage chewing up your profits. And if you compare this to like the small cap stocks or altcoins or meme coins, where one big order can literally cause the entire market to move against you, right? Like those markets are heavily manipulated because institutions have a very large influence over it. But with futures, it's very difficult for them to move it and manipulate it. And here's something most beginners don't know about. If you're in the US, futures trading comes with like a unique tax advantage under the 60-40 rule. That means 60% of your gains are taxed at the long-term capital gains rate, even if you're day trading. And it's really like the most favorable setups that you can have as like an active trader, right? It actually incentivizes you to trade futures. And when you put this together, regulation, leverage, liquidity, and nearly 24-hour access and even tax benefits, it's no surprise that like so many professional traders, especially those in US, are choosing futures as their weapon of choice. Now, let's get practical. Step 1 is to understand what you are trading. So what the hell exactly are futures? At the simplest level, a futures contract is a standardized agreement to buy or sell an asset at a specific price in the future. They are traded on regulated exchanges like what I mentioned earlier, like the CME. Originally, they were used by hedgers. Think about it like farmers locking in grain prices or airlines hedging futures. So originally, futures were used by hedgers, right? Just think about the farmers, farming the land, they want to lock in grain prices. Then they'll buy commodity futures. Or airlines trying to hedge fuel, right? Oil, energy, etc. But now they are also heavily traded by speculators like us. And the beauty is that you don't need to actually own the underlying asset, right? It's not like real estate where you have to buy the thing physically and it becomes very difficult to sell the thing. With futures, you just control the exposure, right? This is why like you can have like a small amount of money, like a small amount of margin, and it can give you access to large positions. Now, here's some examples of future contracts. The E-mini S&P 500, otherwise known as ES. And it pretty much represents 50 times the index value. So if the S&P 500 is sitting at $5,000 right now, the ES contract controls $250,000 worth of exposure. I will explain what all this means later on, right? But just know that another example is the gold futures contract, right? Which pretty much represents 100 ounces of gold. So if gold is trading at $2,000 per ounce $200,000 right now, that single contract is worth $200,000 in exposure. And basically what I'm trying to say here is that you don't need to put up the full 250k or $200,000 to trade them, right? Like you don't need to have this large amount of money sitting in your account. You just need to put up the margin, which might be just a few $1,000s, right? Especially if you are using leverage. That's the power of futures. You can trade with like a small margin, a small account, and you can have large exposure, which means that you can have large profits or large losses if you don't manage your risk properly, which I'm going to show you how to do later on. Now, in futures, you've got a few main categories to choose from. Number one is indices. These are contracts that track the major stock indices, like the S&P 500, the Nasdaq 100, which is NQ, the Dow Jones, which is YM, right? These are by far the most popular among active traders because they are highly liquid, they move cleanly, and they offer plenty of setups every single day. If you are a beginner, this is where I recommend you to start, right? This is like the level 1 of playing like a video game. Don't even bother going to the next level, which is commodities, because it's like trying to slay the next level boss without fighting the minions of the boss. Doesn't make sense. Next is commodities. Commodities is pretty much things like crude oil, CL, natural gas, NG, and gold, right? GC. Basically like the two-letter thing is pretty much like the abbreviation of the asset. These markets can move very, very fast because they react to the news, right? The fundamentals shifting the economy, supply shocks, and even geopolitical events like wars and like if Trump do this, left versus right, whatever. And they can be insanely profitable, right? Because they move very, very fast. But I wouldn't recommend you to do it if you're like a beginner because of the volatility level, right? It's much more volatile, which means price tends to jump up and down much more quicker and much more often, right? They are always fluctuating. Next, we got the FX futures, right? Which is currencies. Contracts like the euro, which is 6E, and the yen 6J, or the British pound, which is 6B. Now, these are similar to Forex, but the key difference is that you are trading them on like a centralized exchange instead of an unregulated shady-ass broker. Currency futures can be a good fit if you like macro themes and you like longer term swings, right? Which means if you like to hold a trade for a few days up to a few weeks, currency futures probably be like a decent fit for you. Now, if you're brand new, I highly recommend you starting with the micro index futures, right? Which is the MES for the S&P 500 and the MNQ for the Nasdaq, because they are highly liquid, they're affordable, and they are incredibly beginner friendly. It's like you get the same setups as the big contracts, but with 1/10 of the size, right? So mistakes are literally causing you less money, which means you lose less money and you can have like a larger upside, right? So it's like a no-brainer. If you're like a beginner, stick to the micro index futures. Don't even try to play the big boys game right now. And also you want to make sure that you match your trading to your lifestyle. If you're in Asia, right, you might want to catch the London or the US overlap session. And if you're in the United States, you've got the New York morning session, which is usually like the most active one if you're considering like futures as a whole. And one last tip, until you're consistent, avoid thin contracts with low liquidity. This can chew you up with slippage and bad fills. Like it's incredibly costly to trade this. It's like, why try something like this which is not going to have like a good upside? It's like you're much better off just sticking with the names like ES, NQ, the micro, S&P, futures, MES, MNQ, right? Where the volume is always there and the market is highly liquid. Now let's quickly talk about trading platforms. A trading platform is simply the software you will use to view the charts and execute trades. Think of it as your cockpit, your performance panel. It's where you're able to see your price action, place orders, analyze the charts, and manage your risks. And some of the most popular platforms for future traders are listed on the screen right now. They are NinjaTrader, TraderVate, TradingView, and Thinkorswim. NinjaTrader is incredibly popular for futures traders because it has like advanced order flow tools, custom indicators, and like a very strong community. And that's the one that I would actually recommend you if you want to just trade on like a platform that is specifically built for futures. Now, TraderVate, I've never really tried it myself, can't give too many comments on it, but I just know that it's beginner friendly, it's simple to use, it's fast, and it has straightforward pricing. And a lot of new traders, they tend to start there. But like I said, I can't speak too much about this because I don't use it myself. And then we got TradingView, right? This is the platform that you want to be using to analyze your charts. It's the cleanest platform out there. It's incredible for charting. And the good thing about TradingView is that you can also connect it to like certain brokers so you can place trades directly on TradingView itself. move. But yeah, a lot of people just use it for like charting and then have like another execution platform, just like NinjaTrader. And then we got Thinkorswim, which is one of the best all-in-one platforms for charting and analysis. It's powerful, right? But it's a bit heavy on your resource and it's not as futures focused as NinjaTrader or TraderVate. But like I said, a lot of traders, they still use it successfully, right? Especially if they already have accounts with TD Ameritrade. Now, the key here is that you want to pick that one platform that has clean charting, right? So you can actually analyze the charts properly and see the market clearly. And you also want to have one that have stable data feeds, right? So that you don't miss the move. And most importantly, one with a good order entry system. So your stop loss and take profit orders are automatically managed. Now, if that said, just don't overcomplicate this step. Just pick one platform, commit to it, and just learn everything you need to know about that platform, right? For me personally, if I'm trading futures, all I use is NinjaTrader or TradingView. That's it. Because like when you start hopping from platform to platform every single month, it just like slows your progress, right? Like all of this platform works. Just stick to one execution platform where it's the one where you want to enter the buy and sell manually, and one charting platform which is the one that you want to analyze the charts. And ideally, if you want to simplify things even further, just stick to like one platform for both charting and execution, which would be NinjaTrader, right? If that's the one that you want to go for. Now, in order to make money in trading, you need to have money. Like it takes money to make money. So there are two main ways to fund your trading journey. Number one is self-funded. This is where you deposit your own hard-earned money, your own capital. It could be a few $100s, it could be a few $1,000s. And then this is where you try to trade like micro contracts to manage risks. And the benefit with self-funding is freedom. It's like you fully control your own account. That means you set your own rules and there's no one constantly looking over your shoulder. And like I said earlier on, because futures offer like a huge margin, huge leverage, this means that even with $1,000, you can trade one micro contract and just practice discipline, practice execution, and just build consistency without the pressure of evaluations. Which brings us to the next option, which is prop firms. Now, these firms, they let you trade their capital once you pass an evaluation, right? So it's like a rite of passage to prove to them that you are actually consistent, right? So that they will actually trust you the money. Popular ones are FTMO, the 5%ers, and Funded Next. And the big benefit is that you don't risk much of your own money. And the big benefit here with prop firms is that you don't risk much of your own money. So if you pass, you can access accounts up to 50K, 100K, or even like 200K, or even some with like 400K. So you basically trade their money, which means that they incur the downside. But when you actually make money, when you make a profit, you have to split it with the prop firm, right? Depending on the prop firm, the target. And since you are trading their money, the catch here is that you have to follow their rules, right? Which is daily drawdown limits, profit targets, and like pretty much other consistency requirements. Which also means that if you break the rules, your account gets terminated by that 500K funding that you have gone in 1 minute because you broke a rule. So which is the best option? Well, if you are brand new, my advice is just start by learning with your own small capital. Like just start with $1,000. And this $1,000 is not for you to make money, right? It's for you to pay market tuition, right? It's for you to get familiar with what it's like to trade live with your hard-earned money on the line, which means that you need to learn how to handle your emotions, you need to learn how to analyze the charts and become under pressure. And like I said, it's really like just market tuition for you to get used to the execution platform, the markets, and how to manage risk properly. And once you have built up like a profitable track record, right, that means you are consistent for 6 months, right? You actually see money coming in every single month. Then you can consider using prop firms to start scaling your account, right? Because at that point, you are already like developed the skill set that is needed to actually keep the account and actually scale to 6 and 7 figures. So before you place a trade, you need to understand the contract that you are trading. So let's quickly go through the most common futures contract one by one. Now, first of all, you must understand that every futures contract comes with 2 key numbers, tick size and tick value. Tick size is basically the smallest price movement the contract can make. And tick value is how much money you win or you lose every time the market moves by 1 tick. And a point is usually made up of several ticks, right? So don't confuse the point value with the tick value. A point is simply just a whole number that moves on the index, which means today if you go to TradingView and you search NASDAQ and you see the price of NASDAQ move from 15,000 to 15,001, that means price is just moved by 1 point, not by 1 tick, but 1 point. But the thing is, futures, they move in ticks, not decimals, right? So So here's how to figure out how much 1 point is worth, right? So let's just use the Nasdaq 100 E-mini for example, right? Like the first future contract that you can see on the screen right now. What you want to do in order to calculate the point is to take the tick size, figure out how many ticks are in 1 point, and then multiply by the tick value. So for example, on the Nasdaq E-mini, we have 1 tick, right, which is $5. And 1 full point contains 4 ticks, since every single tick size is 0.25, right? If you think about it, 0.25 times 4, that's 1 full point, right? 1 full tick, so to speak. So 1 point equal 4 ticks times $5 equal $20, right? That is why if price moved by 1 point on the chart, price is moving $20, right? Not $5, not 0.25, but $20. And that's pretty much how you calculate points in relation to ticks. Now, bear in mind that if you want to trade this future contract, this is the margin that is required for your trading account, right? Which is quite a lot, right? Like $17,600. Which brings us to the next future contract, which is like a mini version of this initial contract, and that's the Nasdaq 100 Micro, right? MNQ. And this is the same tick size, but the tick value is only 50 cents per tick, which means that 1 point equals $2. Once again, just do the quick calculation, quick math. 1 point equal 4 tickets. 4 tickets times $0.5, which is the tick value, it gives you $2, right? So yeah, $2 per point. And you can see the initial margin here is a lot smaller, right? It's only like $1,760, which is why most beginners, they just start with the Nasdaq 100 Micro, right? So just stick to this one if you are like just starting out. And then you have the S&P 500 E-mini, right? Where the tick size is 0.25 and it's worth $12.50 per tick or $50 per point, and the margin is around $15,400, right? So it's mainly for bigger accounts and so on and so forth, right? You can just continue explore like the other numbers that we have on the screen right now. So quite simply put, bigger contracts, which is the E-mini contracts, they have larger tick values, which means that you need to have higher margin in order to trade this. And then the smaller contracts, which is like the micro little contracts with the micro at the end of their name, this is where you are trading with 1/10 of the size, which is perfect for beginners. Now that you have understood tick values, the next step is to calculate your position size. This is the most important skills in risk management, right? Because it literally decides whether you survive long enough to get consistent. So here's the formula. Contracts equal risk dollars, how much money are you risking on this trade, divided by stop ticks times tick value. Sounds like a whole bunch of jargon that your mind can't comprehend? Don't worry, let's quickly just go through like an example. So this is an example on the micro S&P 500. So let's say today your account size is $2,000 and you risk 1% per trade, which is $20, and your stop loss is 8 ticks away, okay? Your stop loss is 8 ticks away, which is 2 points, and you are trading $10 per contract. And since it's $10 per contract, you take how much money you are risking, which is $20, divided by your stop loss, right, which is $10 per contract. Guess what? You find out your lot size. As simple as that. Now, since you have figured out your stop loss and how much money are you risking per trade, all you need to do now is to take your risk per trade, which is $20, divided by the dollars per contract, which is $10, and you got your lot size, right? You got your position size. So this means that you need to trade with 2 contracts. And anything more than that means that you're risking more than 1% per trade, which is not what you want to do. That's it. When you do the math, it actually forces you to be disciplined. So the thing is, I don't want to complicate this, right? I don't want you to be calculating like an Asian on like a math exam every single day. No, just use a position size calculator. Make your life easier. Go to this website right here, input your account size, input your stop loss, input your risk per trade, and it will automatically calculate the lot size for you. I'm going to show you how to use the calculator later when we go into the charts. But this calculator basically ensures that you never use a lot size that is way too big for your account, even though you feel like tempted to ramp up the lot because you feel extremely confident for the trade. And here's the thing, if your stop loss is way too wide for your account size, the calculator literally tells you that you should sit out of the trade, right? So just try out like the calculator. And this is exactly how professionals, they stay in the game. Every single trade is precise before they actually enter into the trade, right? There is no single trade that will potentially blow your account because you are very intentional in about how much money you are risking on each trade. And this is what winning in trading is all about, right? It's not about hitting the home runs. It's about staying in the game long enough for your edge to play out, right? So that you can eventually accumulate like the mini home runs that will actually allow you to get consistent returns. Now, what most people don't realize is that futures, they trade almost 24 hours a day, like what I mentioned earlier, which means the market opens on Sunday evening and it runs all the way through Friday evening with only like a short break each day between 5 p.m. to 6 p.m. New York time. And this round-the-clock access is a huge advantage compared to stocks, because with stocks you can only trade like when the New York stock market is open. But with futures, you can trade different sessions, right? You can trade at any point of time throughout the entire 23 hours. There's the Asia session, the London session, or the New York session. And most importantly, you can find the time that fits your lifestyle and your time zone and trade during that session. And this also means that you are never really locked out of trading opportunities, even if you're working a 9-to-5 job. Like, there's opportunities every single day. But like I said, just take note of like the daily break, which is like 5 p.m. to 6 p.m. And during that 1 hour, the market reset and liquidity just pauses, right? So other than that 1 hour, you can trade at any time, any day from Sunday to Friday evening. Now, another thing that a lot of beginners often miss is futures contracts expire. So if you're trading index futures like the S&P 500 or the NASDAQ, you must understand that they roll over quarterly. March, June, September, December. And if you're trading commodities like crude oil or gold, these contracts, they roll monthly. Now, what the does rollover means? Well, I want you to think of it like a bus ticket that runs out. Each contract has an expiry date that is attached to it. If you want to keep trading the same market, you just hop on to the next bus, which is the next contract month. That's called rolling over. Now, here's a simple example. If you are trading the September S&P 500 contract and it gets close to expiry, you just need to switch into the December contract. Like, you don't have to wait until December to trade. Both contracts, they are live at the same time. You just need to move into the next contract month early, because that's where all the volume and liquidity is shifting towards. And like, let's operationalize it even more. I want you to just think of it like changing lanes on a highway, right? The September lane is ending right now. So you just slide over into the December lane and you just keep driving. So you're trading the same market, it's just a different contract month. And pro tip, always check your broker's rollover calendar so you don't get stuck in an expiring contract. Because once a contract expires, you will either get closed out automatically or you will have to risk unexpected costs. And that's like absolutely not necessary. And here's something important. Futures, they are incredible for scalpers and for day traders. But for swing traders, expiry can sometimes get in the way, right? Which means that if you hold trades for weeks, you will eventually have to roll into the next contract, which adds an extra layer of complexity. And this is why a lot of traders, they use futures for intraday and short-term trades. And then while longer-term traders, they often stick to ETF or Forex. By the way, if you have enjoyed this video so far and you're from the United States, please click on like and subscribe. Because what it does is that it tells the algorithm that this video is worth pushing out to other traders in the US who primarily focus on futures. It's free, it costs you nothing, but what you are able to do is to just give this video to a new trader and just pay it forward. And ultimately, this will allow us to help more people and change more lives. Let's get back to the video. Now, this isn't just theory. Real traders, students just like you, they have used this exact simplified approach to pass funding challenges and grow accounts. For example, here's one of my top students called Syed, who took a $10,000 account and scaled it to $291,000 using this exact mechanical trading system, which I'm about to show you. And it's not just one story. We have an endless scroll of student results in our program, as you can see right here. You can see all the students who got funded and also here and here, right? At any point of time, you can just pause this video and just like look through every single one of these win right here. So I can assure you that what I'm about to share with you, the strategy which I'm about to share with you, actually works. Not just for me, but for hundreds of students out there. And the reason they succeed isn't because they got lucky or they got sickness. It's because they follow a simple mechanical strategy that remove emotions and keep them consistent. So if that's it, let me walk you through that strategy right now, step by step on the charts. So what you can see on the screen right now is the entire simplified mechanical trade plan that we're going to be using today to trade futures. So basically, to keep things simple, we are only going to be using two time frames, a higher time frame and a lower time frame. And since like I mentioned earlier on, there is this rollover thing, which means that we don't really want to swing trade futures too much. We want to focus on the short-term trading for futures, which is why I've used the 5 minute as the higher time frame and the 1 minute as lower time frame. Now, bear in mind that this is extremely fast-paced, right? So if you're more of like an intraday trader, instead of using the 5 minute as the higher time frame, you want to use the 1 hour. And then instead of using the 1 minute as the lower time frame, you want to use the 15-minute time frame, right? So these are pretty much interchangeable depending on your trading style and the time frames that you are looking at and the time horizon that you're going to be holding the trade for. But for the sake of this video, right, just to keep things simple, we're going to be trading in the eyes of a scalpel, right? Which means we are looking to get in and out within a few hours, right? Or sometimes even within 60 to 30 minutes or so, right? Not too long. So on the higher time frame, this is what you want to look for, right? This simple 3-step process. The first step is to identify the break of structure, because this tells us whether price is creating higher highs and higher lows or lower highs and lower lows, which tell us the trend direction, right? So if price is bullish, obviously you want to look for longs. If price is bearish, you want to look for shorts. And this also allows us to identify the swing range that we are trading within, right? So once you identify the break of structure, right, which is the point where price actually took out the last swing high, you will know that this is the swing low and the next swing high will be formed once price start making like a significant pullback. And this is the range that we want to focus our time, our energy, our attention on, which means we don't focus on what's happened 5 years ago or what happened in the past, what's going to happen in the unpredictable future. No, we just focus on the present moment, and this swing range decides the present moment. All right, then once we got a break of structure, we are anticipating price to start pulling back. Okay, so when price start pulling back, our job is to just wait for the pullback to be over. And this is why it's so important for you to develop the character trait of being patient, right? Like, just wait for price to get down to your desired point of interest, create like a new high low right here, so that price can eventually continue this uptrend and take out the next high, creating the next break of structure. So what we are looking for is to just enter at this low right here, right? Enter at this new higher low that is going to be formed in the next few hours, right? Now, how do we know when price is going to start? Now, how do we know exactly where price is going to start to reverse and head up again? Well, we look for our supply and demand zones. And most importantly, we want to look for the high probability zones. And to me, a high probability supply demand zone is one that have led to a break of structure, right? Which means it's somewhere around here. It led to price taking out this swing high right here, which means it led to like a break of structure. And then it also created imbalance, right? Which means there was a lot more of buy orders that will pump into the market at this price point, which caused price to actually leave like a gap behind, which is the imbalance. I'm going to show you on the charts later on. And then it also must sweep liquidity, right? So if I look at this low right here, it pretty much swept some liquidity below this low here, which means that it triggered the people who entered for long positions right here and placed their stop loss below these lows. Those stop losses got triggered out, and that is what I call a liquidity sweep, which allows price to fuel the move to the upside, right? So it needs to meet at least 3 of these criteria in order for me to determine it as like a high probability supply and demand zone. And your job as a high probability trader is not to deploy your capital on every single trade that you see on the market. Just because the market is open 23 hours a day doesn't mean that you need to trade every single hour. Your job is to pick the best trades with the odds stacked in your favor, which means in this particular scenario, if you enter for a short right here, yeah, you can try to play the pullback in the short term, but because you are going against the higher time frame order flow, it is technically not a high probability setup, right? Which means you're much better off being very patient, waiting for price comes down, mitigate your demand zone, high probability demand zone, look for your entry model, right? And find like the turning point, right? Which signal to us that price is about to do this. Which brings us to step 3. Step 3 is that you want to wait for the supply and demand zone mitigation. Which means if price is in the middle of nowhere right here, right, consolidating or doing whatever the hell you want right here, you don't care. Because price is not at your desired price point, right? So you just ignore it, okay? So you just be patient, wait for price to get to your desired point of interest. Once it does, then you want to look for your entry model, which is this beautiful charts right here, right? These beautiful patterns right here. And here's pro tip. Do not enter on the first reaction, because the first reaction is usually an inducement, which is pretty much like a bait laid by professional traders to entice retail traders to enter early, right? To enter for a long position early, just for them to generate available liquidity below that low right here, and then later for them to sweep the low before the real move actually happens, right? So if you're constantly getting stopped out over and over again and you're not knowing why, this is why. If you can't spot the liquidity, then my friend, you are the liquidity, right? So do not enter on the first reaction. So once price mitigate your point of interest, go and look for your entry model. I've given you 2 entry models that you can pick right here. You got the aggressive entry model, which is for people who are more risk-seeking, right? My adrenaline junkies out there. And then we got the conservative entry, which is for people who are more risk-averse, right? Which is the people who like to play it safe and wait for extra confirmation before they actually enter for the trade. Now, one is not better than the other, right? Both have pros and cons. For example, if you use the aggressive entry, you're more likely to get stopped up more often, right? Because like I said, it's super duper aggressive. You're entering right after the liquidity sweep. But then if you just purely use the conservative entry model, you will realize that a lot of times price will not pull back, right? Price will just blast right straight to the moon and just take off without pulling back to your point of interest. Okay, so like I said, pick one, go and backtest the hell of it, and then choose the one and stick to the one that works for you, right? So the aggressive entry model is basically like what I mentioned over here, right? You wait for price to mitigate the point of interest, right? Your 5-minute demand zone. Once it does, you don't enter on the first reaction, right? You don't enter when price actually bounce off like this demand zone. You wait for price to take out that liquidity that is below this low first, wait for the second move, and then you ride the second leg to the upside. So this is where you actually look for a long position, right? Honestly, I should have drawn like this thing a little bit lower because it needs to touch the zone and then goes up, and then this will be the inducement. Now, and then if you look at the conservative entry, it's the exact same thing. The only difference now is that you are waiting for a market shift, which confirms to you that the internal structure is indeed shifting bullish and the pullback is over. And right now we are shifting back to the bullish, and like right now the lower time frame structure is in alignment with the higher time frame bullish structure. And then now instead of entering right here after the market shift, you are waiting for price to pull back to the lower time frame demand zone, right? The 1-minute demand zone that created this market shift. And this is where you are looking for your longs, right? So this is the more conservative, the more play it safe entry model. Now that we have understood at a high level how to actually use this mechanical trade plan, let's go on to the charts and let's apply what we have learned. Alright, so like I said, TradingView is the charting platform that I normally use to trade futures. Very simple. When you click on this currency pair right here, you are able to search whatever symbol of the future that you want to trade, right? For example, if I want to trade, let's say the S&P 500 mini futures, right? Just search it right there and then it will show up, right? You can see E-mini, this is the one that you want to trade. And if I want to trade the micro version of that, it'll be this one right here. And today, this is the one that we're going to be looking at because I'm assuming that a lot of you guys are more sort of like beginner sort of stuff, right? Like more catered towards beginners. So let's look at the micro E-mini futures. Okay, so this is pretty much what the chart looks like. And according to the trade plan, the first step is to always identify the break of structure, right? To tell us what is the trend direction. And over here, you can see price goes up, pulls back, goes up, and take out this previous high that we have on the left-hand side, which means this is the point where price actually broke structure. And since we got price taking out the last week high, this tells us that price is in a bullish uptrend, which means, just like what I mentioned in the entry model earlier, we want to wait for price to pull back, wait for the pullback to be over, wait for price to create a new higher low, and then we look for longs right here to trade in continuation with this bullish market structure. Right, so as a result, right here, you draw your breakout structure, that's step one. You identify that the trend is bullish, that's step one. The next step is to identify the point of interest, the supply and demand zone that led to the breakout structure, right? So if by the way, I'm on a 5-minute time frame, which I mentioned earlier, which is the higher time frame. So this is where I want to be drawing my higher time frame demand zone, right? So look at this. How do you draw a demand zone, right? You look at the lowest point that led to the breakout structure, and you want to find like the consolidation, right? So like this sort of like consolidation move right here, or some form of like pivot just like this, and you will mark this entire thing as your demand zone, right? So if that's the case, if I'm looking at this, what happens is that price goes down, pulls back, goes down, pulls back, goes down, consolidate here, goes up, pulls back, and then goes up, right? So in order for me to find the point of interest that is high probability, ideally I want to look for the extreme zones, right? So if I look at the left hand side, I will see that this right here is the entire consolidation that led to price breaking out of this box, creating this demand and fueling price and taking out this high here, right? So this is our demand zone, right? So I'll take a box tool, draw it from the high, right, the highest point of the box to the lowest point of the box, and then just drag it to the right side just like this. Okay, simple demand zone. Now it's time to actually validate it, right? To prove that it is indeed a high probability zone which price is going to respect rather than just blow right past it, right? This is why we trade high probability zones, right? Because with high probability zones, price has a much higher chance of respecting it, and then price can go up in our way, right? To the fantasy land, right? So over here, first criteria is, did it break structural? Yes, it did. Did it create an imbalance? Let's take a look, right? So if I go down to the 1 minute time frame, like I said, I want to see imbalance, right? Imbalance is pretty much price creating like a huge bullish momentum to the upside. And ideally, right, I want to see some form of gap just like this. When there is a gap, right, between, basically what you want to do is to spot like a big bullish candle, right? A big bullish candle or a big bearish candle. That's the secret right here. Because a big bullish or bearish candle usually tell us that there is imbalance, right? Usually tell us that there is a gap, right? Which means that there was a large amount of buy orders that stepped into the market at this price point here. Okay, so this is the gap where price is going to gravitate towards. This is what we define as an imbalance, right? So it has the imbalance right here. It has break structural. The last thing is, did it sweep liquidity, right? So if I look at the left hand side right here, what do we have? We got price comes down, pulls back, goes down, pulls back. This is where a lot of retail traders, they think that, oh, I see a double bottom, I'm gonna enter for a long right here because this is what the textbooks are showing me, right? Just gonna enter for a buy when I see this buttocks pattern, right? And then what happens is that they place a stop loss below this low here, price later come down, stop them out, right? And then they cry and they complain and they lament, and this is where you got the liquidity sweep, right? And then price goes up, right? So yep, it swept liquidity, it broke structural, it has imbalance. This means that it is into the high probability zone, right? So now that we have validated the zone, next step is to just wait for price to mitigate the zone. And until price mitigate the zone, we do absolutely nothing. Okay, so if price is like somewhere around here, you see, right here, you do nothing. Like, you just play with your fingers. I don't care if they're stuck in your thumb, but you do nothing, right? You do nothing until price step into the zone. All right, so let's wait. Price goes down, boom, bam, ping. This is where you start going down to the 1 minute time frame and you try to get involved, right? Not get involved, but observe. Because remember, we don't get in on the first mitigation. The first mitigation is usually the inducement, right? So let's observe, right? So you can see right here, oh my god, retail traders are getting excited again, right? They're entering for longs right here and placing the stop loss below this lows here, right? Because obviously price is mitigated the demand zone, we're gonna go to the moon, right? But what they fail to realize is that this is an inducement, and this is why we don't enter on the first move, and this is why a lot of you guys are getting stopped out right now. You guys are entering on the first move thinking that, oh, price is gonna go do this right now, price is just gonna magically shoot up like Jack and the Beanstalk. That's not the case, right? Smart money, they have to induce, entice retail traders to enter early to generate available liquidity so that they have sufficient liquidity to fuel price up. Price does not move without an objective. Price does not move without liquidity. Liquidity acts as the fuel that causes price to pump straight to the moon, right? So in this particular case itself, just to time travel a little bit, price goes back, retail traders get in, but you don't get in, you stay out because you know that this is just an inducement, and you wait and you play with your fingers, you suck in your thumb until price take out that low. Once price take out that low here, you got your liquidity sweep, my friend. And my friend, game over. This is where you get in for a long position, right? You wait for the liquidity sweep at the high probability point of interest, then you get in for a long right here, and you place your stop loss below this low here, right? Make sure you place it below this low, right? Because like I said, you want to get the most precise entry possible, right? So your stop loss shouldn't be like all the way down here, right? It's just below here. If you want to play it safe, you can put it below the point of interest as well, right? Because this is the point of interest that it's going to hold, right? But for majority of my professional gamblers out there, you're good just by placing a stop loss below this liquidation candle, right? So yeah, this is what I call a liquidation candle. It's pretty much the candle that liquidated that low right there. And then I'll take profit. To keep it simple and mechanical, we are just gonna target 2R, which is twice our stop loss distance, right? So this is our stop loss, and we adjust this until this thing turns to 2, right? Risk to reward ratio 1.6, 1.7, 1.8, 1.9, and then we got 2 right here. That's it. Right, so just to revisit how to calculate your lot size, go to your futures contract calculator, right? The website that I've actually given you guys in a slide. If not, just go and search future contract calculator. And let's say today you are trading with like a $10,000 account, right? Let's say $10,000 account. And yeah, we are trading ES Micro, right? So wait, let's see this. ES Micro, yep, ES Micro. And then we are trading $10,000, right? First step is to select the future that you are trading. In this particular case, we are trading ES Micro, right? Which is the S&P 500, the micro contract. And then let's assume that we have $10,000 in our account balance. That's inputted. Next thing is to input your stop loss. For a stop loss, very simple. Go to your long position or short position tool that you have placed on the chart right now and look at this figure right here, right? Look at this this figure right here. Not this one here, not this one right here, but the one in the middle, which says 10, right? So your stop loss right now is 10 points away from your entry price, and your take profit is 20 points away from your entry price, right? So just get the number in the middle, right? So you got that, put it in the stop loss points right here, and then put how much money are you risking on this trade itself. Yeah, for a majority of my traders out there, you're much better off just risking 1% per trade, right? So let's just stick to 1% per trade. Boom, automatically that does the calculation for you, and you will know that you need to use 2 contracts, right? 2 contracts. So you go to NinjaTrader or whatever broker that you're using. Before you enter a buy and sell, you input 2 contract, enter for a buy, you place your stop loss at this price point, you place your take profit at this price point, or whatever the price is on your broker, and you enter. That's it. Tada! You've just entered your first trade on futures. Congrats, buddy. Now let's see whether you actually win this trade or not, right? So price goes up slowly, right? Slowly trickling down. Oh no, but you stay calm, you stay patient. Price hit TP. As simple as that, right? Like you could have panicked right here. If you panic right here, guess what? You got out right here. You get frantic and you start to wonder like, oh my god, this market is a scam, right? Just to see price go up in a way, right? So like I said, patient pays off. That's it. If you are patient enough to wait for price to get your point of interest, and you're patient enough to wait for your trade to hit your TP, my friend, you are going to have a very long trading career. But if you're impatient, right? You're trying to rush and make money, rush to become a millionaire in 3 days, my friend, you're gonna have a short-lived trading career. Up to you. Now, that's it. Let's move on to the next currency example. Now, let's look at another example, but this time we are shorting instead, right? We are looking at it in like an inverted perspective. We are looking for shorts, right? So in this particular case, what happened was that price goes up, comes down, goes up, comes down, and take out this low right here. So when this happens, this is a market shift, okay? A market shift is pretty much when price breaks structural and the trend is reversing from an uptrend to a downtrend, right? Because by rights, if we were to trade in alignment with the trend, what's going to happen is that price is going to create higher highs and higher low, and then goes up and take out this high. But in this case, price actually went down here and take out the previous low, right? Giving us a market shift, which means that right now the structure is shifting from bullish to bearish, right? So knowing that, this is where we can identify our market shift. We'll draw a market shift right here. And this is where price broke structure. First step, price broke structure to the downside. Trend direction is bearish, we should be looking for shorts. Second step, identify a point of interest. Now, if you look at this, where is the extreme point of interest that led to break of structure, that led to the market shift? It's going to be this one right here. It's going to be this, because this is the highest point that led to price breaking structure, right? So you mark the highest point, the highest wick of the candle within the range to the lowest wick of the candle within the range, and you drag it out just like this. And this, my friend, will be your 5-minute supply zone, all right? 5-minute supply zone. Now, like I said, in order to make it high property, we need to add more criteria, more confluences onto it. Did it break structural? Yes, it did. Did it have imbalance? Yes, it does. This is clear as day imbalance, right? Clear as day, just institutions selling off, right? Institutions selling pressure, whatever you like to call it. And did it swap liquidity? Yes, it did, right? If you look at the left-hand side here, what we have was that price went up, comes down, price goes up, create this super long wick, right? Failed to take out this high, candlestick failed to close above this high, and then just started going down, it just started crashing. So clear as day, you got a beautiful liquidity strip right here. And that, my friend, is a high probability point of interest that I want to be trading from. So now, third step, do nothing until price mitigate that zone. Suck on a pacifier, whatever, price mitigate that zone, boom. Now I'm interested. Now I'm gonna get involved. All right, so the minute price actually mitigate the zone on a 5-minute time frame, you can just go down to the 1-minute time frame, right? So go down to a lower time frame, look for an entry model. Now, if you recall, our entry model basically says that we should wait for price to mitigate the zone, and we do not enter on the first mitigation, right? We enter after price sweep the high of the first initial mitigation, right? So in this particular case, price mitigate the zone, what do? Do nothing, right? Put your hands away from the keyboard, do nothing, and you wait. Patient. Wait. Boom. There we have it. There we have it. That's our entry signal right there. Because what happens is that right now, price has just swept the available liquidity above this high here. Now, why is this so important? I can't emphasize how important this is. Because a lot of times, if you are impatient and you are rushing to get into the trade, entering right after the first move, guess what? You're going to be placing a stop loss above this high, right? Above the liquidation candle, right? And then you're going to get stopped out just to see price go in your way, right? Like later on, just to see price go in your way. And then you're going to sit there and regret and have your balls in your hands, not knowing what to do, right? Like I said, patient, right? Now, once the liquidation actually happens, this, my friend, is where you look for shorts. Enter for a short right here, place your stop loss above the liquidation candle, place your take profit at 2R, right? Just like this. Easy, set, and forget. Price goes up, price go down, slowly. No, don't go back into the red. No, don't get scared. Boom, price hit a stop loss. No, price hit a take profit. Boom, as simple as that, we call it a day. Checkmate, baby. Now, it's as simple as that, guys. Now, if there's one key lesson that I want you to take away from this little live trade analysis, it's the fact that the only constant in trading is losses. Losses is inevitable. You will always incur losses no matter how good you're at. Now, if there's one key lesson I want you to take away from this entire lesson, it's the fact that amateurs obsess over entries while professionals obsess over exits. Think about it. Losses are the only constant in trading. No matter how good you are at trading, no matter how large your trading account gets, no matter how profitable you get, you will never get rid of losses. Losses are inevitable. It's that cockroach in your kitchen that just can't die no matter how much you beat it. It's inevitable, which means it is important for you to do everything you can to minimize your losses. Because when you minimize your losses, right, which is the cost of doing business, you are maximizing your profits without doing anything extra. It's like the business will actually focus on cutting costs. It's like they know that profits are cyclical, right, and the market can have ups and downs. But when they just focus on the constant, right, which is the variable that is within their control, which is the losses, which is the cost, guess what? Just by cutting the cost, they're automatically going to make more profit, right, because they can have like a much more higher profit margin, which means higher net profits, which means more money in the company's bank account. It's the exact same thing right here. Losses, they will never go away, right? Surprise, surprise, it will never go away. You will never have like a 100% win rate, like ever. I mean, like you can have it from time to time, but you will not sustain that 100% win rate, which means if losses are impermanent, which means if losses are always going to be there in our trading journey, let's do whatever we can to minimize risk, which is why we only risk 1% per trade, and that is why we stay consistent with the amount of money that we risk. Because if you're able to stay consistent in terms of how much you're risking, then your profits will be consistent as well, right? Because whenever you lose, you're always losing 1%, but when you win, you're winning 2%, right? 2R. And then if you extrapolate that take profit to like 5R or 10R, guess what? One big win can eventually make up for the 5 previous losses if your trade have like a 1:5R take profit. Now, just to show you that I didn't pluck this strategy out of my ass, this is pretty much backtested results of this particular mechanical trade plan. What I did was that I took the strategy, I took the principles, I took the risk parameters, put it onto like a sort of like a stimulator, and you will see that if you start off with $1,000 and you risk 1% per trade and your win rate is 45%, right, which is very reasonable and achievable with this strategy, and your risk to reward is 1:2, like what we've just shared, and you've taken 100 trades, right, where you let the edge play out over the law of large numbers, right, over this large sample size. What happens is that at the end of the 100 trades, you will get like a 58% P&L, which means you will make $580 if you have a $1,000 account. Think about how insane that is. You pretty much just make 58% of your account, right? Like almost double the account just by focusing on minimizing your risk, cutting your losses. And then if you have 20K in your account, guess what? You just made 11K. 11K over the span of 100 trades. And that, my friend, is the power of being consistent in terms of the way that you actually manage your trade, right? And if you look at this, it's not like we win a lot of trades, right? It's like I said, we have like a 45% win rate, which means technically we are losing more trades that we win. But because we manage our risk well, like a professional trader, what happens is that we manage to become profitable. And not even just profitable, but like wildly profitable beyond my dreams, right? All by making sure that my risk is minuscule and my profits is outsized. Now, we have seen the strategy in action and the backtest results, but I don't just want you to take my word for it. Let me show you what real students are achieving with this exact system. These are traders who started just like you, confused, inconsistent, maybe blowing accounts, but once they applied my mechanical trading system, they focus on risk management, master their psychology, their results change forever. So what you can see on the screen right now is just a few of our video testimonials which you can find on our 1% Club YouTube channel. On top of that, here are just a few of the countless of 5-star reviews that we have received on Trustpilot. Now bear in mind that this isn't like cherry pick, right? This is the consistent feedback that we get from traders who join us, they follow the system and they've put in the work. You can see this is insane. Like just look at the wall of 5-star reviews that we have right here, really cementing us as the best trading mentorship program in the entire industry. At any point of time, feel free to just pause and just read, but yeah, you can just go through this and you can find more on our Trustpilot page, right? Just go to our Trustpilot page and you will see like this program is indeed the only program in the entire industry that actually get results. And if you're still not drowned by my social proof yet and you want to see more student results and wins, just go to this website right here. Now, unlike other trading gurus out there, I'll be honest with do. Not everyone makes it. And the reason most beginners fail isn't because the strategy doesn't work. It's because they fall into the same traps that I once fell into. Like what I promised you at the start of this video, I want to share with you 3 beginner tips that can save you months of frustration and thousands of dollars. Let's break it down. The first tip is one that took me so long to understand, but I just wish someone could travel back in time and just shout this at me and just embed this into my subconscious mind. And that is, do not get distracted by the women in the red dress. I'm not sure whether you've seen The Matrix, but if you've seen The Matrix, you will know that at some point of time, Neo was walking down the street and then she was like staring at this beautiful woman in the red dress. And then boom, it turns out to be like one of his teammates or something, right? But because he was distracted, it kept him from seeing the truth. And it's the same thing with trading. In trading, just like in The Matrix, the real enemy isn't the market. It's the distractions that are keeping you from seeing the truth. Like when you start trading, you just know that this is the path that you need to walk, right? This is the path that's going to lead you to consistent profitability. And it's usually like a list of things. It's a list of boring and repetitive tasks that you must do for an extended period of time. Like starting one strategy, mastering that one strategy, backtesting, journaling, reviewing the data that you have gathered. It's incredibly mundane, boring, and repetitive, and nobody likes to do it because everybody's attracted to novelty, right? They want the next shiny thing, which is why you get attracted to the guaranteed returns strategy, the signal group which promise you heaven, the holy grail ICT strategy. And what happens is that when you hop from one strategy to another strategy, you are pretty much resetting your competence levels. Because like when you start something, right, it takes at least 21 days to kind of get a hang of that thing, right? Like for example, if you start trading today, you start trading market mechanics, which is this strategy that we just taught you today. What happens is that it takes you a few days of practicing it over and over again to even get decent at executing that trade plan. Not good, but like decent. It takes you weeks or even months or even years to master the trade plan. But what happens is that when you start to just do this, right? You start to do this thing, you start to execute and try to master this trade plan, but then you don't persevere with it. The moment you start seeing resistance, the moment you start seeing losses, the moment you start encountering setbacks and obstacles, you automatically think, this doesn't work. Let me just go to the next new thing. Let me just go try this new YouTuber strategy. This guy is posing in front of Lamborghini, right? I'm just gonna learn from him, you know what? And then when you learn his strategy and you found that it doesn't work, you skip to the next guru and the next guru, and you're stuck in this endless cycle of getting good at something, resetting back to baseline and trying to get good again, and then resetting back to baseline again. And what happens is that your competence as a trader is just keep on resetting to zero. It's just like in a video game, you die and then you respawn. And then you die and then you respawn. So it's like you're always going back to the initial checkpoint which you started the game from. When in reality, what if you just focus on the path that will actually lead you to profitability? That's the guaranteed path. The guaranteed path is if you do the boring and the repetitive tasks for an extended period of time, the tasks that a professional trader does on like a daily basis, you are pretty much guaranteed to become successful. But like I said, the hard part is just doing it. The hard part is just doing the work every single day when you're not seeing any results whatsoever. But at the end of the day, mastery in trading doesn't come from different trading strategies. It comes from mastering one trading strategy, one trading style, and one asset class. So if you are starting to trade futures today, right? Don't start trading crypto or stocks because your friend is making money from crypto or stocks. Stick to it. This is the path of most resistance, but this is the path that is going to be the most rewarding at the same time, right? So if you can just keep on walking this path every single day, you focus on your own lane, at your own pace, at your own way, and you ignore everyone else, you ignore all the distractions, because distractions is just things that is keeping you away from your goal. What happens is that eventually 3 years from now, 5 years from now, you're just going to look back and realize how far you've came. And all you did to achieve success was by doing the boring things for such a long time. The next tip is to understand the competence curve. The competence curve basically states that there is 4 stages of learning in trading. The first stage is unconscious incompetence. This is where you first encounter trading. You're like, oh my god, if this 20-year-old can do it, I can do it as well. It's so easy to just click a buy and sell button and make money. So I'm just gonna hop onto the market, get a broker, right? Learn by watching a bunch of videos and just start trading. And at this point of time, your confidence is sky high, right? Because you've seen so many people done it, and you've seen so many people like became successful with it, so you automatically think that you can do it. And the thing is, beginner's luck is on your side. So what happens is that when you start taking a few trades based on the new strategy that you just learned, you are going to win some trades, right? Like you are going to make some money. But that's false sense of confidence. It does not last long. What happens next is that you hit a losing streak. And when you hit a losing streak, this, my friend, is where you transit to the next stage, which is the conscious incompetence stage. Which is when you are conscious, when you're aware of the fact that, damn, this thing isn't as easy as I thought it is. It's actually pretty damn difficult, right? So your confidence level starts dropping. And at this point, you just realize how difficult trading it really is. And this is what I call the danger zone. At this point of time, it's where so many traders, they just throw in the towel and they just quit running this marathon. They're like, I just encountered some resistance. I just see some obstacles and challenges. It's too hard for me. You know what? I'm just gonna give up. What if you just reframe challenges and obstacles as you building your story? Because if I think about it right now, like 7 years in the game, and I look back at my year 1 and year 2, I realized that all the challenges, all the losses, all the mistakes that I committed was just me building myself, building my identity as a trader. Because all those beginner mistakes allow me to learn lessons, right? Lessons which propel me to consistent profits. But in that particular situation, I don't view them as lessons. I just view them as God punishing me and thinking that trading is not for me. Now, there is this exercise that I like to do, which is called forecasting. It's like forecasting to me 5 years from now. So if I'm in my 2nd year of trading and I'm encountering like a losing streak right now and deciding whether I should quit or whether I should continue trading, what I'll do in that situation is just forecast and speak to the future me. Like I would literally imagine myself 5 years from now speaking to the me in this present moment and giving advice on what to do in this situation. Like just think about it. Would the you in 5 years from now ask you to quit? No, right? Because he has probably realized that all this shit that you're eating right now is just building you into a better trader. Someone who's able to stay calm under adverse situations. Someone who's able to just overcome losses with equanimity. That it's like every single loss that you face, it is essentially a diamond that is covered in dirt. And by reviewing and reflecting on the loss, you are wiping away the dirt to get the diamond, which is the wisdom that you need to prevent you from making the same mistake in the future, to prevent you from losing this trade again, right? Like prevent you from losing more money down the road. That's what a loss is, right? So if you can just reframe losses, reframe challenges and obstacles as opportunities for you to get better, then you're able to make it past this phase. And like I said, this is where 95% of traders quit. Right? They don't see results, they don't see validation from the outer world, they start throwing the towel, and like I said, they move on to the next asset, right? They move on to the next strategy, they move on to the next shiny, make money online opportunity like AI agents or affiliate marketing or some bullshit like this, right? When in reality, if you just push on and just push through and just stay on the path, you're gonna make it to the next stage, which is conscious competence. Conscious competence occurs when you start trading successfully, right? It's like when you start getting good at trading. And at this point of time, you kind of realize that trading is not about money. It's about becoming a skilled trader. Because when you become a skilled trader, right, when you develop the skill set of a professional trader, the money automatically comes, right? The results come as a byproduct of you focusing on the process. Like how ironic is it, right? It's like you start off with trading, focusing on the money, but that over attachment to money drives money away. When you start focusing on the process, you put all your time, energy, and attention into getting better, into executing your trade plan, into just reviewing your trades. You start to refine your trade plan. You start to improve your trade plan. And what happens next is that you start to get better at trading. And when you start to get better at trading, because you focus on the process, you actually start seeing results. You actually start seeing profits. That's it. Like, that's the holy grail right there. Like, there is no holy grail strategy. The holy grail comes in you reviewing your own trading and discovering what are your strengths, what are your weaknesses, what are the things that you're good at, what are the things that you're bad at, how to make your entry much more precise, how to exit with like a higher profit, how to utilize the right trade management method so that you can actually get outsized returns, how to manage your risk, how to handle your emotions. That is the holy grail. It's a series of things. It's a lot of different variables, which, like I said, takes a lot of time and experience to master, right? And that, my friend, is conscious competence. It's like you are starting to see results, but you're still learning. Stage 4, the final stage. This stage, it could take you quite some time to get to. But once you get to, trust me, everything changes. And this is unconscious competence. This is where trading becomes second nature. Right now, if I go onto TradingView and I pull up any chart, any blank chart, I can finish analyzing the charts in 5 minutes. Or even like in 1 minute if I really just focus on it. Now, bear in mind that it took me 7 years to get to this level. It's like riding a bicycle. When you first start to ride a bicycle, you keep on fall, right? You can't really balance. But after a few rounds of riding the bicycle, you eventually get the hang of it. And you don't even think about putting your foot on the pedal. You don't even think about like staying in balance. You can just do it without thinking about it. Right? That's you treating cycling as second nature. And that's unconscious competence. It's where you have really mastered the markets and you've understood how price works, why price move, and you are so fluent in terms of just executing a trading plan that you don't hesitate anymore, right? You no longer second guess your setups. You see the opportunity, you enter, you execute without hesitation, reservation, or fear. And all while maintaining discipline and focus and still continuously getting better. That, my friend, is the ultimate level of a professional trader that I hope every single one of you watching this gets to. But like I said, you're not going to get there overnight. It's going to suck for a very long time. And if you give up when you're sucking, right? You give up when you don't see results, you're never going to make it past stage 3, much less stage 4. And my friend, stage 4 is where the big money is at. Stage 4 is where you have mastered the skill set and now it's just a matter of scaling up. If you think about it, right? If today, I give you the ability to just predict price with 100% certainty, 100% precision, bro, you're going to be printing money every single day. You're going to be just milking the market for profits every single day. Well, what is that skill? That is the skill of a professional trader, right? That is a skill set of a professional trader. The ability to see the market for what it is. And the only way you can get that skill is by unlocking unconscious competence. And the only way you can unlock unconscious competence is if you play the game long enough that you get so good at trading that it really becomes second nature. Which brings me to the third tip, and that is trading is not a linear journey, it's an exponential journey. What I mean by that is that a lot of retail traders, they think that when they start trading, they're automatically just gonna make money every single month and the equity curve is just gonna go up like this. When in reality, it's gonna suck for a very long period of time before you start seeing consistent results. Not results here and there, not make 5K here and there, not turn $100 to $500 and then lose it all, but consistent results. I'm talking about like profits every single month, every single quarter, every single year. And here's where it gets interesting. The consistent results comes at this point right here, right? So if you look at the exponential curve, you stagnate, right? You don't see results. And then eventually you figure these things out, right? You got your aha moment, right? And you start unlocking mastery and boom, your result just skyrocket to the upside. And this inflection point, the point where it goes from flat line to exponential growth, that is the point that you want to last long enough to get to. Right? So what I mean by that is that when you're not seeing any results and you're overwhelmed with fear, losses, blown accounts, self-doubt, insecurity, your family doesn't believe in you, your friends are shoveling shit at you, they say that you can't do it, just get a job, right? All this stuff, right? What happens is that you're on here. And if you quit, what happens is that you might be one trade away from the inflection point. From the point which leads to exponential growth. But because you quit 1 inch away from gold, you never dig the gold up to begin with to enjoy the gold. When in reality, you could just be one trade away, right? This is why I always say the quality that you want to develop as a trader is the quality of being unstoppable. Because if you don't quit, you can't lose. Like, think about it. You're pretty much guaranteed to become successful at trading if you just put in 3 years, 5 years. But because you're unrealistic when it comes to the deadline for your goals, you give up before you start seeing results. Right? Like for example, oh, today I'm going to become a millionaire trader in 3 days or 3 weeks, 3 months, whatever. And when it hits that 3 months mark and you are not a millionaire trader, what happens is that you start losing faith, trust, confidence in your trading abilities, in the market, and you quit. When in reality, if you just keep going, eventually you will become a millionaire trader. So I always say that the bigger your goals are, the bigger your timeline must be in order to match that goal. But the thing is, the bigger your timeline is, the easier it is for you to achieve your goal. Because now you're not thinking about mastering this entire mechanical trading strategy in 3 months. but you're just thinking about breaking the elephant down and eating the elephant piece by piece. Alright, how can I just master the entries today? How can I master the exits tomorrow? How can I master risk management next week? How can I master psychology next month? And what happens next is that you gain more experience, you gain more knowledge, you gain more wisdom from the markets. Over the long run, right, in 3 years, in 5 years, eventually you become a millionaire trader. All because you have took the elephant, which is a big ass goal, you break it down into chunks, actionable steps that you can take every single day, and you just do that one thing every single day. And you just let time do its thing. You can see the exponential curve right here. To me, personally, the inflection point came in my 3rd year of trading. It didn't come in my 1st year, it didn't come in my 2nd year. Which means that if I decided to quit in my 1st year, I would have not lasted long enough to get exponential growth in my trading results. And bear in mind that my 1st year was the worst. I was working as a waiter earning $7 per hour until 2 a.m. Can you think about it? Like, I'll go to school from like morning until like 6 p.m. And then 6 p.m. onwards, I'll go and work as a waiter at like a restaurant, waiting tables, cleaning tables from 7 p.m. until 2 a.m. Sometimes I would even skip dinner because I was so busy. And then from 2 a.m., I'll just go back home. Now wake up early, try to wake up at like 4 and 5 a.m. just to study the charts, just to backtest, just to trade on my demo account. And like, I didn't see any results. But yet I was like trading with every paycheck that I got, like $1,000 paycheck, I just put it in my trading account. And then I'll blow it. And then I'll blow it again and again. Every single time I put the $1,000 that I earned from me as a busboy into my trading account, I blew it. But I just kept going because I knew for a fact that I would eventually make it. I didn't know exactly when I'll be successful, when I'll be rich, but I know with every ounce of my being that eventually I will get rich. And that's quality of being unstoppable allow me to get to where I am today. I'm making 6 figures per month, I'm living in my dream apartment, living my dream life, my parents are retired, everything is good now. That, my friend, is me enjoying the fruits of my labor because my labor was wet, sweaty, disgusting, and arduous, right? Like, I had to eat shit for 5 years before I can eat caviar for a lifetime. So if you're watching this and you are facing the obstacles, the challenges, and you can't seem to find a way out, just know that as long as you do not quit, you will have a chance of making it to the inflection point where you will finally figure things out. And when you figure things out, like you really got the aha moment and you see the market for what it is rather than what you think it is, right? The objective truth of the market, my friend, that is where you unlock financial freedom. Or rather, you're one step closer to unlocking financial freedom because now you have finally listened to what the market is trying to tell you all this time around. Right? But like I said, it's lasting all the way to that inflection point. That is the hard part. So if you can just keep going, keep persevering, eventually you're going to get there. And like, before we end this, I just want to say one thing. The thing about trading is that you cannot win trading. You can't just win the game because trading is an infinite game. It's not a finite game. A finite game is a game with fixed rules, fixed players, and a clear endpoint. Right? Think about like soccer or football. There's 2 teams, there's 90 minutes, there's 1 winner. Right? So eventually someone actually win the game, right? Because it's a finite game. And an infinite game has changing players. And the rules are always evolving and there is no finish line. And that pretty much just describes the markets. The market is always evolving year after year. There's always new traders, new players, and there is no finish line. You can't just win trading, right? It's this never-ending marathon. So the only way to win an infinite game is to just keep playing. Right? That's the tip. Just keep playing. The only way you can win in the long term is to just keep playing. Which means that you need to preserve your capital. Which means that you need to protect your capital, minimize your losses, maximize your profits. You need to manage your risk, and you need to avoid the silly mistakes that cause you to blow up, right? Blow up all your hard-earned money. Like the good old adage on Wall Street, if you don't bet, you can't win. If you don't have chips, you can't bet, right? It's all about like preserving your capital for the high probability setups that actually stack the odds in your favor so that you can actually win, right? That's it. But like I said, once you quit, you're out of the game forever. And that's good news for me because I'm looking at you, I'm like, thank God that guy quit, man. Because I'm just gonna keep going. And if I keep going, I will eventually just get better. And if I get better, I'll just eventually make more money. And I'll just keep on running this marathon, like this infinite marathon. Because trading is like a marathon. And the person who keeps going, the person who enjoys running, will always run further than the person who's only running for the applause at the end of the finish line. Like if you're just running for validation or the external outcome, and you don't actually love this game, you're eventually just going to, I'm just gonna run laps around you, right? Because I actually love the financial markets. I don't know whether I can tell from like this entire video, but I actually love playing this game. And I love like just making these videos and just giving back to the community. But anyways, those are the 3 tips that I wanted to share with you today. Like, please, younger bret, if you're watching this, take these 3 tips, tattoo it onto your brain, right? Put it as your wallpaper, write it down somewhere, memorize it, and just remind yourself of them every single day. Every single day you feel like quitting, every single day you encounter a losing streak, just remember these tips. And you'll just keep going, and you'll keep on playing the long game, the infinite game of trading, and eventually you will make it. And eventually I'm going to be so proud of you, man. Now, if you want to take the next step, I've put together a 2-hour-long exclusive live masterclass which contains my mechanical trading system and everything you need to know to become like profitable in this video right here. Like I said, it's an exclusive video, right? It's not even public, right? So just go and watch it. I made it for you, man. And as always, remember, you're just one trade away. One trade away, baby.